to another episode of Ascentis TV. On this month's show, Lee Koznowski has got an interview with Dext, Mark Overend's got his tax tip and his quick tip. I'm continuing my series on DISC, and Lee will round it all off with AdminMin as usual. So without further ado, let's get started. Let's jump straight to that interview that Lee conducted with Freddie from Dext.
Hi everyone, so today in Tech Talk we're going to look at the potential solution to a common problem we've been facing within the practice. With all the new sales and payment platforms, we've had some real difficulties trying to consolidate all this information into the accounting systems. We've had poor integrations which either pull information through intermittently or in more worrying cases just not at all. And VAT seems to be a particular issue in this area. There has been some movement in this technology though, and one of the market leaders has emerged from Dext. So to help us talk through their new feature, I've asked Freddie from Dext along to Ascentis TV. Here's what he had to say. So welcome to Ascentis TV, Freddie. Thank you very much for joining us. It's great to see you.
And Judy Lee, yeah, thanks very much for having me. How are you?
Yeah, very good, thank you. So I didn't know if you could just start by giving us a quick introduction to yourself, what you do at Dext, but then maybe talk about Receipt Bank and how it evolved into Dext and what you hope to achieve from the rebrand.
Yeah, definitely. So just to start off, introducing myself, my name is Freddie. I work in the practice solutions team here at Dext. So I spent a number of years working in practice, and I've been here for a couple of years now, where I help enable all the different products that we have here now at Dext. In terms of the history of the company to get to where we are now, we were previously known as Receipt Bank, as Lee just said, where we had the one product which we were best known for. That product focuses on the extraction and automation of cost data, so any expense receipts that are coming through the business. So it extracts the data and automates that part. Since then, we have evolved into a multi-product platform. We rebranded to Dext in 2021 to encapsulate this new vision of going into different products. And we've actually been through various funding rounds and investments since then as well, which has helped support that growth, with our most recent acquisition being Dexcommerce, which is our new shiny toy that we've got now.
Perfect. So yeah, that takes us directly to Dexcommerce, which is the main focus of this. I didn't know if you just wanted to give us a little overview of what it does.
For sure, yeah. So in terms of Dexcommerce, what we do is we connect to sales platforms. So if anyone out there is selling on the likes of Shopify or Amazon or eBay, or maybe they're collecting payments through PayPal or Stripe, what Dexcommerce does is it captures information from these different platforms. It automates the categorization of that data. It then pushes that data into either Xero or QuickBooks as reconciled information. So the idea here is to automate and making sure it's accurate as well, the data that's coming from these platforms into your accounting software.
So you've mentioned some of the big hitters there. I didn't know if you could give us an insight into some of the other platforms that you integrate with.
Sure, yeah. So in terms of our sort of core integrations or marketplaces, we have the likes of Amazon Seller Central, eBay, Shopify, Etsy, but also platforms like Square. So if you've got some terminals in some restaurants, that kind of thing, we also deal with those kind of businesses. We've got Stripe, PayPal, WooCommerce for websites. So quite a variety of different platforms. And what we've tried to do is have an area that if you sell on these multiple platforms, it's all going to come into that same place and be dealt with in the same way. So yeah, we do integrate with quite a few different marketplaces currently.
Fantastic. And is Dexcommerce aimed at anyone in particular?
Yeah, I'd say it's our sweet spot is anyone that's selling on these kind of platforms that maybe are currently doing it manually and spending a bit of time doing that, getting it into either Xero or QuickBooks, because from experience it can be quite a hassle making sure it's accurate for MTD, but also getting it in efficiently. So we're speaking to quite a few people who have said actually it's taking quite a lot of time to get that information into the platform. So yeah, by using something like this, it's freeing up a bit of time, so they don't have to worry about the nitty gritty of getting the data in, but actually focus on growing their business, which is obviously what we all want to be doing.
Yeah, and I've seen it's been a real pain point for some of our other clients where they've got multiple platforms where they're selling from, and then getting the accounting entries from that becomes quite a manual process.
Yeah.
So I guess in that sense, are there any benefits for customers actually signing up through a preferred partner like Ascentis?
Yeah, so we actually partner with firms like accountancy practices like Ascentis, because we know that actually there is quite a lot of accounting knowledge you need to get this data in accurately. So that's definitely a big bonus of partnering with Ascentis and going through that route, is that you do get that expertise that they can give in terms of the setup. There's also a better price going through someone like Ascentis, because we partner with them and we like Lee, so we can give them a better price than if you were to go directly. So that's another benefit. And we know as well, through Lee, you do get really good support in terms of that setup initially, for sure.
And I guess because we've mentioned price there, it takes us on to a really good point in terms of return on investment. So I imagine there is a little bit of a setup cost involved, but what kind of return on investment have you seen in business cases that you've dealt with recently?
Yeah, so I've actually got an example here. If I just switch over to this next slide. So this is an example of one of the businesses that we've helped recently. Steph was spending over 8 hours each week downloading her digital sales from 5 different platforms. So Steph was selling on different platforms. She then implemented Dexcommerce, which captured the information from each platform automatically, automated it and pushed it straight into Xero for her. And she was able to reduce her workload by over 50%. And she's told us that she's now been able to spend that time growing her business. So, the more integrations you have, it can become quite time consuming. And yeah, it's really useful to have a system in place just to make sure that information is going in a bit more efficiently. So yeah, we've got quite a few cases like this where someone has come to us and said, we're spending quite a lot of time doing this. A bit of configuration at the start to get Dexcommerce all linked in, but once it's linked in, you can get quite a good return on investment for sure.
Yeah, we really try and stress, efficiency through automation. Nobody wants to be doing that manual inputting. Let the computers do that. They're much better at it than us. And then you can focus on the other areas. So look, there's probably a lot of people out there who have got all these multiple different platforms. There's all sorts of options for taking payment off people, and why wouldn't you kind of make that available to people? So have you got any advice for anyone that seems to be overwhelmed by all these kind of different sales platforms at the moment?
Yeah, I mean, it's what I would definitely say is don't get put off by going to using different platforms just because it's a hassle getting it into a Xero QuickBooks. There are solutions out there that can help with automating it. So we came across quite a few people who said, look, we do want to sell on different platforms. We want to collect payments through different ways, but we don't want to do it because we know the hassle at the other end, getting it out into Xero. So my suggestion would be, find a solution that does consolidate all that information, automate that part of it. So it's, again, freeing you up to do the more valuable stuff.
Very good advice. Thank you for that. So listen, that does sound like a really good solution to the problem I identified kind of at the beginning of this tech talk. I didn't know if it was appropriate or if you could just show us a little demonstration so people can actually see Dexcommerce in action.
Yeah, for sure. Let me just switch over to my other screen. Here we go. Hopefully you can see that okay, Lee?
Yes, yeah.
That's great. So yeah, this is Dexcommerce. This is what you would see if you linked all of your accounts in to Dexcommerce as a business. So you can see here, this particular example, we have a client that has multiple integrations. We've got Shopify, Etsy, Amazon. So they're selling products on different integrations. And then we've got Xero linked as well. And what we've got on Dexcommerce is I'd say two main areas. We've got the transactions tab and we've got the bulk export area. The transactions tab is showing all transactions across all of the accounts that you sell on. So again, we talked about, selling on multiple platforms and how, downloading reports from Amazon and eBay and maybe manipulating that to put it into Xero can be a bit of a hassle. Yeah. Well, on Dexcommerce, what you get is an area where you can see all the transactions from a bit of a higher level. you can see here we give a snapshot of the total sales, refunds, fees and reimbursements from each platform. And you can see the totals up in the right hand corner here. You can filter to the different platforms here as well to give you the different data. And we've also got this search area as well. So again, this is a really good, almost like a holding area. Before that data is going to hit 0, it's there so you can search different date ranges. You can match the data against the different reports in Amazon, for example. You can see the date range filter here. And what that's going to do is allow you to see the data before it hits 0, or maybe when you're trying to retrospectively reconcile that data. So again, a lot of partners we work with really like this area to, identify what transactions have flowed into the platform.
Great benchmarking as well to which platforms are generating the most sales.
Exactly, yeah. So you can use it as almost like an insight as well. That's right, Lee. So if you want to see across all your platforms, maybe who are you paying the most fees to? Because actually, if you're paying too many fees to one platform, maybe you want to start to look at focusing on the other platform. So again, this is the area that you can compare and contrast against the different platforms, total sales, fees, refunds. I suppose if you've got different platforms and you're looking at each report individually, you don't sort of get that sort of cross insight that you do on this dashboard. So yeah, we do get really good feedback on this area, that actually now it's all in one place. You can see the differences between the different platforms. We also give quite good information in terms of the information from each transaction. So if I scroll down here and click into a transaction, you can see that we give really granular detail in terms of every transaction that's pulled in. And what that does is it allows us to then set various rules on the transactions to make sure it's being categorized correctly. So making sure that the right VAT is applied, making sure it's going to the right chart of account code. All this information here, we can then use to map to push into 0 into the correct place. So we've heard quite a few stories of people downloading reports, putting that information into a CSV, putting onto a spreadsheet, finding out the VAT, with these intricate Excel formulas. But what Dexcommerce does is bring it all in and sort of map it all for you, so you don't have to use Excel to almost bridge that across. Perfect. Especially as we sort of move into MTD, and it's important to have that digital link, right, Lee? So this also is MTD compliant and getting it in compliantly. So we also tick that box as well.
Fantastic.
Yeah. I'll just really quickly show this bulk export area, because this is where we get the data in. So this bulk export is then going to allow whoever's working on the job to then send these transactions to the right place within 0. So almost like our other product, Dext Prepare, you're sort of mapping each transaction to the right account, to the right contact, to the right chart of account code in 0 QuickBooks. So sending the sales to sales, for example. And as you export these items, they're going to all flow into 0 into the correct places. Quite a new feature as well, Lee. I'm not sure if you've seen this yet. It's fairly newly dropped in. We've also got auto export in Dexcommerce now. So, items flow in, automatically map, and now automatically publish into either 0 or QuickBooks. So when set up properly, it can be, fully hands off and giving people a bit of time back.
Popular feature in what was Receipt Bank and now Dext Prepare as well.
Yes, definitely. Yeah, very heavily used.
Excellent. Look, that's really useful insight. Thank you. And I will check out Freddie's fridges to see if I can get any discounts on my white goods there. It's been really useful you joining us and taking us around Dexcommerce. I'm sure people will have a lot more questions, but we can deal with them on a one-to-one. There's lots to go through with Dexcommerce, but as a concept and as a tool to actually gather in all them different sales platforms is a really useful piece of software, and we've benefited from it recently with some of our clients that we've used as well.
Great.
So thank you very much for that demonstration.
No problem. Yeah, really, really good to be on here. Thanks, Lee.
Yeah, lovely to chat to you, Freddie, and take care, and we'll see you soon.
Great. Thanks, Lee.
Cheers. See you later.
Thanks, Lee. Great stuff. That's a product that's going to save people a tremendous amount of time if you are selling online off multiple platforms. Right, it's time for Mark's tax tips, and he's got a great idea as to how you can pay your children's school fees from your limited company.
Hi, welcome to this month's Ascentis Tax Tips. This month we're going to be addressing a question that we get asked quite regularly, which is, can I pay the school fees for my children through my limited company? Now, if you were to pay the school fees for your own children as a director or employee of a limited company, then unfortunately you'll be subject to income tax and national insurance on those payments in the same way as you would be if you were drawing the money out as dividends or as salary. So where you're a parent looking to meet school fees for your immediate children, the answer is there isn't really any benefit to doing it directly from the company, because it's just going to cost you as much tax as it would if you drew the money out in any normal way. Now, that's not the end of the story, because there are possibilities to implement some tax planning that could allow individuals to meet school fees for children using a trust structure. Now, what would happen is trust would receive some shares from that individual. They would gift the shares to the trust. The trust would then, having ownership over those shares, be able to receive dividend income. And if the children who are currently in private education are beneficiaries of the trust, then the trust can be directed to meet the school fees of those children and potentially save everybody involved a great deal of income tax. So, who can do this sort of planning? Well, as I mentioned, if parents try to implement this planning, then what's called the settlements legislation applies, and it prevents parents from undertaking the planning, because it states that where income that arises under settlement is paid or made available to the minor child of the settler, then the settlements legislation will treat the income as the income of the settlor, which means that effectively if you placed your own shares into a trust and use that trust to meet the school fees of your immediate children, you will be taxed on that income in the same way as I described first of all if the company simply paid the fees directly. However, that settlements legislation only applies to parents and their immediate children. It does not apply to grandparents and their grandchildren. So if grandparents are still involved in the running of a limited company, or even not particularly involved in the running of it but have shares in the limited company, then they can undertake this planning potentially for their grandchildren. Some initial considerations that grandparents would need to make in this instance. First of all, what sort of trust should we be using? There's various different sorts of trusts, and it's important to consider not just the immediate use of the trust, i.e. potentially to meet private school fees, but some fairly longer term considerations, such as will the trust continue to meet university fees, and will it be used further down the line to pass wealth in the future to those children, perhaps as part of wider inheritance tax and estate planning as the grandparents grow older and older into their old age. There also needs to be a consideration on the impact of the income of the grandparents. At present, it might be that grandparents are in business with the parents of the children, i.e. the grandparents' children, who are adults now, and they're running a family business together. The grandparents may be reliant on the dividend income at the moment for their own lifestyle and to meet their own income needs, and they may not be picking up the tab for the private education at the moment. It might be that their children, who are the parents of the grandchildren, are meeting those school fees, and so we need to consider carefully the income position of all family members and ensure that nobody inadvertently reduces their income to a point where they struggle to meet their day-to-day living requirements. So, as I mentioned before, the mechanics of the planning are relatively straightforward, but the complexities come at each stage in considering all the relevant taxes. So, a trust would be established, and the grandparent or grandparents involved would be the settlors of the trust, i.e. they would be the people who create the trust. And the grandparents would be looking to transfer shares in the limited company that they currently own. They would be looking to transfer a proportion of those shares into the trust. Now, transferring any asset into a trust needs careful planning. There's inheritance tax consequences and capital gains tax consequences that need to be considered on any asset transfer, such as these shares. And we need to understand whether any capital gains tax or inheritance tax may arise before we do the planning, because if it does, it may negate some of the benefit and actually make it not really worth doing. There are generally planning areas that can be met in order to avoid these taxes, but it does need careful consideration. Now, once the trust is set up and it has the shares, then it starts to receive the dividend income from the limited company. And once it receives that dividend income, it has to pay income tax on it in the same way as an individual does. But the beneficiaries of the trust are the minor children, the grandchildren of the settlors, and usually they wouldn't have any other income themselves, and therefore they have their tax-free personal allowances available. So each beneficiary, each child, can receive up to £12,500 a year without paying any income tax at all. And if that's the case, the trust is able to reclaim, well, the trust pays the income tax, and then the grandchildren are able to reclaim the income tax paid, thus making the dividend income effectively tax-free in their hands. Once the trust has received the income from the dividends, it can use it to pay the school fees on an ongoing basis. And because it's tax-free, we're looking to save a huge amount of income tax here. So talking about these savings, let's consider a child roughly age 7, about to embark on their private school education career. They're going to be at school for the next 10 years until they've completed their A-levels. Let's take some average private school fees. They're going to be in the region of £10,000 a year. So if the grandparents are currently higher rate taxpayers, they're normally paying 33.5% on their dividends from the 6th of April this year. Anyway, that's what the new income tax rate will be. So the tax saved could be £3,350 a year, because that income that's normally subject to higher rates of tax in the hand of the grandparent will suddenly become subject to no income tax in the hands of the beneficiaries of the trust, because it's falling within their tax-free personal allowance. Now, £3,350 a year tax saved over the next 10 years for one child is going to amount to a total tax saving of £33,500. And of course, if there's more than one child, then we can multiply that £33,500 saving by the number of children. Very easy to get to a saving. If you've got 3 children, you could be saving around £100,000 in income tax. So well worth considering. If there's any grandparents out there with grandchildren who are looking to start private education, or indeed if they're already in private education, it's something you can put in place for children, even if they don't have to be just starting. They could be in the mid-teens, halfway through their private education. It's still very well worth considering. Okay, this month's Ascentis quick tax tip is all about director salaries for 2022-23. We've just started the new income tax year, and in the spring statement, I'm sure many of you will see that the Chancellor decided to increase the employee national insurance threshold, and he announced that it will be coming into line with a tax-free personal allowance. And at face value, it sounds like we should all therefore be paying director salaries of £12,500 a year. But that's not quite the case. First of all, if you're a sole director, you're just the only person on the payroll, and you're looking to keep your administrative affairs as simple as possible, then actually you should be paying yourself a director salary of £9,096 a year, or £758 a month. Now, the reason for that is that whilst the employee threshold for national insurance has been increased, the employer threshold has not. And if you're a sole director, you don't qualify for the employment allowance, and so anything above £758 a year will attract employers' national insurance, and you'll find yourself having to make a very modest but administratively cumbersome contribution to HMRC every month to meet your employer's national insurance liabilities. Now, if you're a director with other staff on the payroll and you are meeting PAYE payments on a regular basis, the most tax efficient salary for you is £11,908 a year, or £992.33 a month. At that level, you're going to attract some employers' national insurance, but the corporation tax saving that you get alongside that offsets it, and so it's worth increasing your salary to this level. It provides the optimal tax saving. The reason we're not paying at £12,050 a year is not just because of the employer's national insurance, because as I said, for directors where they've got a payroll, the saving is offset by corporation tax. The reason we're not going to £12,050 is that whilst the Chancellor has looked to align the two rates, the employee national insurance threshold and the tax-free personal allowance, the change doesn't take effect until the 6th of July this year, and so there is a lag in bringing the employee national insurance allowance up to the tax-free personal allowance threshold. And so if you pay any more than 11,908, you will incur employee national insurance this year.
Brilliant as always, Mark. Thank you very much. You guys got any questions, just get in touch with Mark or any of the tax team here in the office. Right, now it's time for my second episode in this series that I'm doing on DISC and how you use DISC to build highly functioning teams. Hope you enjoy this. Hi everybody, and welcome to episode 2 in my series about DISC and personality profiles in the workplace. It was that great 20th century psychologist Carl Jung that said, until we make the unconscious conscious, it will direct our lives and we'll call it fate. That phrase is going to be a common theme through this series on DISC that I'm going to share with you. Now, it doesn't matter whether I am in a client meeting, whether I'm at a seminar, or whether I'm just at the rugby club at the bar having a couple of pints with some guys that are in business. Sooner or later, the conversation moves on to a story about a dysfunctional member of the team. Right from the board of directors to the new recruits, us human beings are trouble causers, aren't we? But we tell ourselves that our teams are our greatest assets, don't we? Well, at Ascentis, we disagree with that 100%. We believe that your greatest asset is your ability to attract, develop, and retain the right people. I'm going to repeat that because it's really important. We don't believe your team is the greatest asset. We believe your greatest asset is your ability to attract, develop, and retain the right people. And DISC is the tool that you use to achieve that. In episode 1 of this series, I described a business seminar, and specifically 4 individuals making their way to an elevator and how they judged each other either positively or negatively. We just can't help it. We're always judging people. But that judgment comes from our unconscious bias, and that's where dysfunction comes from. We're not fully aware of why we make those judgments or what motivates others to make those judgments about us. DISC is the antidote to solving that dysfunction. So what is a DISC assessment? Well, let's start with what it is and let's dispel some of the myths. A DISC assessment does not measure IQ, aptitude, or intelligence. It doesn't measure values. It doesn't measure mental health. It doesn't measure either good or poor behavior. It doesn't tell you whether one person is better or worse than another. So what does it do? So DISC is an acronym. It stands for dominant, influential, supportive, and conscientious. And all individuals are a blend of all 4 personality types. But as a consequence of your upbringing, education, and life experiences, we're all firmly rooted in one of the 4 personality types. Actually, the world's population is broadly divided up equally between all 4 types, and DISC tells you where you are rooted. By knowing which one of the 4 personality profiles you are rooted within, you will learn what your strengths are, your challenges, and most importantly, your response bias. And by extension, you'll be able to read the profile of other people around you. And you'll be able to change your communication style to suit them, i.e. you will truly empathise with the person that you're speaking to. And when we make these unconscious preferences conscious, the benefits for your business are immense. First of all, you recruit the right people and put them into the right role. So no more square pegs in round holes when you find out a couple of months later you've got the wrong person. It all but eliminates dysfunctional conflict. And it creates trust and commitment within your team, which drives accountability and therefore a solid focus on positive results. And the mere fact that you've invested in a profile assessment for your team tells them that they're valued. And we know from surveys conducted all over the world that feeling valued is the #1 reason why the very best people come and work for you and then stay with you. And we know how expensive, how damaging staff turnover can be, not just financially, but reputationally as well. So let's try and bring this to life a little more with a simple example. Let's say that you're an influential type person, so you're rooted in the I profile, and you're going to see a potential customer to sell them a product. During that conversation, you're an extrovert, so you're naturally going to be upbeat. Your tone of voice is going to be fairly high tempo. There'll probably be quite a lot of small talk in there. You might even tell some amusing stories. Your focus on the detail will probably be quite light, because what you really want to do is focus on the value, and you're eager to get across to that customer the change that it's going to make to their business. And if that potential customer is also an I type, they're also influential, they'll enjoy that exchange. But what if they're a C type? What if they're conscientious? C-type people are naturally distrusting of that level of enthusiasm. They don't consider you their friend, and unfiltered banter is actually unwelcome. They want a granular level of detail about the product, and they'll be naturally skeptical about any change that your product will make to the current way that they're working. You must empathize with them. You need to convey your product's features and benefits in a serious, methodical, and detailed way that makes no suggestion of criticism of the current product they're using. Otherwise, you're going to lose that sale. So there's a great example of I-style behavior. In future episodes, we're going to be looking in detail at all 4 personality profiles and how they react to one another in different situations. The assessment report itself is a really simple thing to produce. It's done by individuals completing an online assessment. It takes about 20 minutes or so, and they're just agreeing or disagreeing with certain statements. For example, accuracy is important to me, or I love to meet new people. And when that individual's report is produced and everybody else is produced, the great thing about Dext is it gives you the holistic view of where you sit on the chart, and most importantly, where you sit in relation to all of the other people in the organisation. So now that you've got this holistic view over where you sit on the chart and other people around you, you can identify what your strengths and your challenges are, but also your unconscious bias and how that can affect other people in a different personality profile to you. And you can adapt, you can empathize, and you can therefore create really productive relationships. In the next episode, we're going to take a deep delve into the D or dominant style profile. So I'll see you then. Okay, so hopefully you recognise that there's quite a lot of the I in me, and for those of you that know Andrew Hartley here in the office, you recognise quite a lot of the D next time when I take you through that profile. Okay, it's time for Lee's AdminMin now to bring you up to date with all of your tax and company's house compliance issues. Take it away, Lee.
Hi everyone, and welcome back to AdminMin. As usual, we've got all the normal regular deadlines for you up on screen there. I would just pay attention to that one at the bottom, the 6th of July for your P11Ds. In terms of other areas, technically from the 1st of April, all those that are voluntary registered for VAT now have to file their VAT returns using Making Tax Digital. Ordinarily, if you're on a quarterly basis, that will be the 7th of July, but it can change depending on your VAT periods. You'll just need to make sure you've got the necessary software in place to file under those terms. On the 1st of June, we've got another round of the advisory fuel rates, so it's well worth logging into that when it happens and just making sure that you're paying the correct rates. Historically or previously, we've said on the 30th of June, the recovery loan scheme application deadline is going to close, and that's still the truth. But what we're seeing now is actually this is being called early by some of the lenders. So Funding Circle has already closed, and Starling will look to close mid-June. Some of the other lenders, such as Lending Crown and Nucleus, are already not accepting new applications. So if the recovery loan scheme is something that you're still wanting to take advantage of, you really need to look at that very, very soon. Finally, it's a little bit in the distance yet, but the 31st of July sees the second payment on account for your tax returns. So this is a real key deadline to make sure you get all your tax return information into your accountants so you can actually assess the correct tax liability. Chances are you may not have to make that full payment on account if your tax liability is lower than previous year. That's it for this episode, and I'll see you next time.
Great stuff, Lee. Okay, guys, you're all up to date. See you next time.